What I would like to do, and what I was asked to do as well a bit, is to touch on Turkish real estate. I understood that in November there was a session mainly focused on retail. So therefore we would like to look a bit beyond retail and also look at what is happening in the office market. Traditionally, one of the markets, let's say, that covers roughly 40% of the investment market in Europe. So what is the status there and how that is developing, especially in Istanbul, the largest market for offices in Turkey. It's not that, it's sleeping. Everybody's speaking about Turkey. It's more and more in media. However, on the real estate side, things are evolving relatively slowly. Most of the focus is on the development side of the market, whilst for example, if we look in CE into the markets where currently most of the interest is, Poland, Russia, their investment volumes have picked up very, very strongly over the last couple of years. So we would like to touch on that and to see how that is evolving potentially in Turkey as well. These are numbers from Oxford Economics and cover 2011, 12, and 13. What I tried to do in most of these slides is make a comparison between Russia, Poland, and Turkey, and then the rest of Europe, just to highlight, let's say, the countries where we currently feel there is most interest in terms of emerging Europe. On the left-hand side, Turkey with 2011, a tremendous growth, around 8.5% real year on year, followed by 2012, a bit slowed down because of the reasons already mentioned. And for next year, or for this year actually, we're expecting slightly over 4% growth. If we compare that to the situation in Russia and Poland, that level is slightly above what we're expecting for Russia and clearly above what we see is currently the forecast for Poland. Poland expected to grow by 1.9%. So the trend in Turkey is up, in Russia it's more or less stable, and in Poland it goes slightly down. Important to know is that that's not only, let's say, the short-term trend, but it's also the medium-term, long-term trend. What I've tried to do, again, based on Oxford Economic numbers, is to highlight the longer-term trend for economic growth in Turkey. And as the previous speaker mentioned as well, the growth rates are hovering around, let's say, 5%, which is almost twice as high mid to long-term compared to Poland and Turkey. Very important to know is that almost 70% of this growth is coming from consumer spending. So consumer spending is one of the major drivers of the economic growth, and that's roughly 10% higher than what we're seeing in Poland and Russia. In terms of investment markets, firstly, I need to state that it's quite difficult to come up with numbers on the Turkish investment market. And I did it with knowledge we have in-house and with the numbers that we got from RCA. But what we collected here in darker green, the numbers for CEE excluding former CIS, so let's say Russia. In the lighter green, we have the former CIS countries, and in the sharp lime green color, we have Turkey. I believe that we only started collecting these numbers after 2007, so forget that period before. But as you can see, especially in Central Europe and in Russia, the numbers started to come up, to grow very, very quickly. In Turkey, on the other hand, the numbers remained relatively small, and a couple of larger deals really caused these numbers to result as they are. So on the one hand side, we are facing a lack of transparency in that market, partially because of the fact that there's a small number of institutional investors, cross-border institutional investors available there. And secondly, the amount of institutional quality stock is relatively low still, and I will come back to that in a second. If we have a bit of a closer look into the volumes for Turkey, it's quite interesting to see that a large portion of that, let's say, quality stock being traded is related to the leisure sector. So leisure is a very important portion of currently the commercial real estate investment market together with retail. So roughly, let's say, 80–90% of the total commercial real estate that is traded relates to these two sectors. And as I already indicated before, for most of the European countries, retail and offices traditionally makes up at least for 80% of the investment market. And if we look at, well, I should point it out there, the dark green colors, that's only offices. So it's a very small portion of the current investment market. In terms of number of deals, we've seen roughly 15 a year, 2007 through 2010. Currently, the trend is declining clearly. Obviously driven by, let's say, a lack of willingness of investors currently to take risk, and risk-free assets are very difficult to find in countries like Turkey and Russia, obviously. So that's causing the declining trend. I don't want to say there is less interest in the country, but it's simply driven by core product available in the market. Parties that recently did acquisitions or are already active for a longer period of time, obviously developers like Multi, Herman will be able to comment on that later on. Uni Investment in the retail sector. Blackstone last year bought a 3-property portfolio from Rodefco, who exited the country. Corio, Fastnet Retail, some high street retail there, and Pradera is considering Turkey as well. So you really see that out of this cross-border institutional group, most of the focus is on retail. So that brings us to the question, why does, let's say, why does the investment market on offices not really pick up? And the reason is not that complex. Obviously, it's complex, but there are 2 major drivers of that. Firstly, the structure of the market has developed in a different way than most of, let's say, the Western markets. On the right-hand side, a picture of, let's say, common office space in Istanbul. So relatively low grade, not of interest, let's say, to institutional investors. Secondly, a picture on the left-hand side is a building being marketed floor by floor. So also there, the buildings are sold floor by floor, which obviously makes it less interesting for institutional investors to look at it. So these are 2 reasons why it's difficult, let's say, to really start seeing the office market picking up. And I think Herman has a couple of interesting notes to add to that later on. At least I hope, Herman, right?
I will try.
From an occupier point of view, the situation is a bit different. We collected these numbers back in 2011, and we did a survey amongst 280 cross-border corporates. And we asked them, and we figured out where their office locations were. Please don't study it in detail, but in blue I highlighted Turkey, so roughly in the middle of the slide. And Turkey, consisting of, let's say, Istanbul and Ankara in this case, roughly covers 41% of the corporates within the country out of our sample. So roughly amounting up to, let's say, 150 occupiers. And this amount is similar to countries like Austria, mainly Vienna, Budapest, and Prague. So in terms of, let's say, occupier presence, most of the occupiers are already there. But obviously, in most of the cases, taking smaller amount of space or are located still in older type of space, not in modern stock. In terms of shares, Istanbul is getting close to the level where Moscow is. Moscow is place 6 worldwide, whilst Istanbul currently is at place 26. If we look down the scale and look at the second city, office city in Turkey, Ankara, city of roughly 4 million inhabitants, is at place 147. So really at a very big distance, indicating, let's say, from an institutional investment point of view for offices, Istanbul really stands out above Ankara. Then coming to the size of the, let's say, the institutional modern office stock in Turkey versus Istanbul versus cities like Warsaw and Moscow. The size of the bubble indicates how big the modern market is. Oh, sorry, what the population size is. So Istanbul is comparable to Moscow in terms of size. It's a bit depending on which statistics you're taking. I've taken official statistics in this case. But the size of the modern market indicated on the left-hand side, modern office stock in million square meters, of the Istanbul market is roughly the same as what we're seeing in Warsaw. So Istanbul, a bit depending on what you count, but currently has around 3 million square meters of modern office space. There is another, let's say, 500,000 underway, making it up by the end of the year, let's say, totaling 3.5 million square meters. Whilst Moscow currently already has 13, 14 million, and almost yearly there is an additional million added to the stock. So there are big, big differences. Obviously, as I said, the occupiers in most of the cases are present in the city already, but in most of the cases they are still seated in older space. Looking at service employment and comparing especially Poland and Turkey. Turkey, as stated, around 75 million inhabitants, Poland around 40. they roughly have the same size of the service employment industry. So the amount of people working in the service industry, indicating that, let's say, the office stock in Turkey has to grow. Especially if we look at the forecast for 2025, the expectation is that the professional and financial services will grow from 1.4 million jobs to 2.6 million. So there's a tremendous growth in the service industry, and especially in the financial and professional service industry, expected over the next 10 to 15 years. So what we said before, the stock is relatively small, and 2008, 2011 didn't show really much growth to that modern stock. But what we are now starting to see happening, 2012, and also the pipeline for 2013, is indicating that the stock is growing roughly by 10 to 15% year on year. So the growth is slowly but surely now coming into the markets, and therefore we expect that more and more occupiers will start moving from older space to newer space. And this is exactly what we've seen happening in most of Central and Eastern Europe, and that process is still underway. Just to put it into perspective, what I've done here is that on the horizontal axis, I've put the development pipeline under construction for 2013 versus the amount of modern stock in the market. And as you can see, Istanbul, again, 13%. Roughly in line with what is happening in the most Eastern European capital cities. So, well, St. Petersburg, obviously not the capital, but big city, as well as Kiev. So these markets are developing now relatively quickly, obviously driven by the fact that the size of the overall market is relatively small. Important to state for Istanbul is that vacancy rates citywide are currently still below 10%, which seems relatively sustainable, especially based on the fact there is a high demand for modern office space in the right locations. Pricing, some of you may know this slide. What we traditionally try to do is show how interesting it currently is for cross-border institutional investors to invest in real estate. The lowest line indicating the 10-year government bond yield, so in principle the risk-free rate. The green line is the weighted average prime yield for, let's say, the core office locations in Western Europe. And then the green line in this case is for Turkey. I have to indicate that the office market, as I said, is still very thin, so therefore getting to yield levels is quite complex. But we feel that, let's say, the yield is realistic around this level, especially looking at currently pending transactions that seem to be potentially trading at lower levels. Generally, risk spreads between the bond yield and the Turkish prime office yield range up to 650 basis points, comparable to the situation that we've seen back in 2003. So overall, based on what we are seeing currently happening on the development side, the demand coming from corporate occupiers, the expectations are that within the next, let's say, 3 to 10 years, the office market, the office institutional investment market in Istanbul is about to change.